Hey, it's Eric with the Future Mill. Today I want to talk about the traditional IRA and a big mistake that I see a lot of people make with the traditional IRA. Now, if you haven't yet, please be sure to like and subscribe to our videos. We have tons of financial education coming at you. When it comes to this video though, I want to talk about the contribution to the traditional IRA and why it may or may not be tax deductible. So let's do this. What people don't realize with their traditional IRA is the traditional IRA may or may not be tax deductible. Now, anything that you put into the traditional IRA, it is tax deferred, but that does not mean that the money that you put in is actually tax deductible. So let's take a look at what exactly that means. So if you're going to say that you made $100,000 for the year, so let's just say you made $100,000, you max out your traditional IRA. So if you put $6,000 into your traditional IRA, that would show, if it is tax deductible, it would show that you actually made $94,000. So what ends up happening is this $6,000 is tax deferred or tax deductible. You are deferring this tax and you will pay it at a later date when you withdraw the money. Now the problem lies here though, is if you have a retirement plan at work. If you have a retirement plan at work, there are certain rules that are in place, and if you make too much money, then you are not able to defer the tax here, and the $6,000 would not be tax deductible. So then you would actually make $100,000, you would contribute $6,000, but it would still show you made $100,000. So this gets really confusing because the $6,000 then goes into your traditional IRA with tax deferred money, but this part isn't tax deferred. Instead, you are actually paying the taxes on it. Now, this becomes a major problem if you want to convert part of your money to a Roth IRA, or if you want to do the notorious Backdoor Roth IRA for a high income earner. Now, I mentioned if you have a retirement plan at work, that is when your contribution may or may not be tax deductible or tax deferred. So let's look at what the IRS classifies as a retirement plan. So you have a 401k plan, a 403b plan, a simple IRA, a SEP IRA, a SARSEP plan, a profit sharing plan, defined benefit plan, money purchase plans, ESOPs, governmental plans, and 457 plans. If you have any of those at work, you may not qualify for the tax deductible contribution for your traditional IRA. Now, this all is going to depend on how much you make. For singles, if you make $65,000 or less and you have a retirement plan at work, your contribution to your traditional IRA will be tax deductible. But if you make between $65,000 and $75,000, then you're going to have a partial deduction, and if you make $75,000 or more, then you cannot deduct your contribution to your traditional IRA. So what ends up happening here, if you can't deduct your contribution to your traditional IRA, is that you have to file Form 8606. Your CPA, or if you're doing the taxes yourself, you are going to do this. And what that form is going to do is help keep up with the fact that part of your money that is in your traditional IRA you've already paid taxes on, the other part you have not. Now, it's not that much of a problem, again, until you go to do a Roth conversion. Because if you do a Roth conversion on this money, you actually are not going to be able to convert all of that money and withdraw it all like you would think with a regular Roth. It's really confusing, as I had mentioned. So what ends up happening is you have a pro rata calculation. So if you have this pro rata calculation that goes into play, part of the money that you convert to Roth is going to be taxable, part of it is not. Now, that is not the norm with a Roth IRA. So when you're doing this, the easiest way to do it is to actually convert all of the traditional IRA, that's all of the money that is tax deferred, and also anything that you may have already paid taxes on, to the Roth IRA. If you are able to do that, then you don't have to worry about the pro rata calculation, and now any of the money that is in the Roth IRA will grow tax-free. This is the same principle for the Backdoor Roth IRA. If you have money that is put in that is not tax deductible into your traditional IRA, you have to convert all of that traditional IRA to Roth money, or when you go to do the Backdoor Roth IRA, again, you're going to fall into this pro rata calculation, and not all of it is going to grow tax-free, and when you withdraw it, it's not always going to be tax-free money like you thought it would. For married couples, it depends on who is covered by the retirement plan at work. If you are working covered by a retirement plan at work, and you want to make a contribution to your traditional IRA, and you make $104,000 or less, 104K or less, then your traditional IRA is tax deductible. But if you make between 104 and 124, then you get a partial deduction. But if you make 124,000 or more, you are not able to deduct your traditional IRA contribution. Now, it is different though if your spouse is covered by the retirement plan at work, but you are not. If that is the case, then how this works is you can make up to $196,000 per year and still contribute to your traditional IRA and it be tax deductible. But if you make between 196 and 206, you get a partial deduction. And if you make $206,000 or more, again, you're back to you can't deduct the contribution. And we go back into this pro rata phase, and that's where it gets confusing, as I had mentioned. So be sure you follow this. Make sure you know what you are doing. If you don't know what you're doing, you are wanting to seek advice on this, go to thefuturemill.com, book a call. We'll be happy to help you.